Hello, everyone, and thanks for joining today. My name is Damon Sutherland, Wealth Advisor with the Sutherland Grant Wealth Group, and today we're excited to be joined by Stephen Lingard from CI Global Asset Management. I'll formally introduce Steve in a few moments, but want to take the time to thank our clients for their continued partnership and trust in our wealth management practice. We continue to live in unprecedented times, and we want to make sure we're keeping our clients updated from an investment management and financial planning perspective. On that note, this is our second in our video series for 2026, focused on investment markets, and feel this communication is quite timely given what's happening around the world right now. As I mentioned, today we're joined by Steve Lingard, someone I've known and worked with for many years. He's an industry veteran with almost 30 years experience and is Senior Vice President and Co-Head of Multi-Asset Strategies at CI. This position provides him a global view of the world today, which I think is very helpful to us and our clients in this market environment. And we're very happy to have him here with us today. Steve, thanks for joining us.
It's great to be here. Thanks, Damon.
Absolutely. So listen, let's jump right in. I want to ask three questions that we've been hearing quite a bit from clients today through the first 4 months of the year and our regular meeting cycle. Let's start with one that we've been hearing in many of our conversations. Obviously, to start the year, there's been a lot happening around the world with the conflict and war in Iran. A very strong start to the year is related to equity markets, and we've seen some volatility over the past 6 or 7 weeks. Just give me kind of a few highlights in terms of what you've been seeing and why we've seen the start to the year that we have.
Sure. And yes, I think if anyone had a war in the Mideast on their bingo card, they would have been a big winner. It's not something that was, even though tensions were generally on the ascent, I would say, with the administration. I mean, we're certainly in a geopolitical bear market, is what we've been talking about for a while, meaning that global trade rules are changing rapidly. Even defense agreements like a NATO, and interesting things like Greenland being challenged by the Trump administration. We can definitely see that there should have been more volatility from a geopolitical perspective. But I think the market overall was a little bit complacent, thinking that midterms were a very key, political date this year, and folks were a little bit surprised that the Trump administration, the U.S., would want to go in and sort of upset what had been, pretty strong growth, inflation that was still elevated, but not, inflecting higher, and that was really key, I think, to an idea that it was going to be all about fiscal policy and the one big beautiful bill and kind of prime the electorate for a midterm election coming in November. But all of a sudden, we saw this excursion into the Middle East, which have lifted oil prices at its high to $115, $120, which is certainly going to undermine some of the positive, trajectory we've had on inflation. Inflation is sort of stuck at 3% and has been for a while. That's probably likely to go up in the next couple of months, just mechanically, with oil prices over $100 a barrel. Now, those have fallen a little bit as we got not a peace agreement, but a truce. But then even over the weekend, we saw that is unraveling a little bit. So oil again is up over $100. So it's been challenging from an asset market perspective. Having said that, I mean, the S&P now is at its all-time highs again, or very near that, over 7,100. Gold has done phenomenally well this year, continuing after a good run last year. Part of that's inflation, part of that's the geopolitical, bear market that we're sort of in. But I think the market is getting smarter and smarter, in the sense that, this escalation. And this dip, just like we saw last year at Liberation Day, is an opportunity to buy the market, because some folks are not fully invested. And obviously, the economy continues to do very well. monetary policy, in addition to fiscal policy globally, is really excessive right now. And I think that's a very good time for earnings, and it's an earnings-driven market that we have if we can get by this sort of challenging geopolitical period. And I think that's what investors really have focused on recently.
And let me just ask about that earnings comment, because I think that's an important one. Ultimately, stock prices are driven by earnings. And you tell me, but earnings seem to have held up really well through these fairly challenging shorter time periods. And the outlook for earnings and Q1 earnings are coming out, seem to be holding up quite well again, right?
Yeah, I think it'll be really critical, more so than what's been printed in the first quarter, because keep in mind, this war began sort of the last day of February into March. So this really is not affecting Q1 earnings, at least in the US, and possibly and probably overseas as well. So it'll be really key to see what the outlooks are from these companies. Here at home, we've seen that one of our major recreational vehicles companies have pulled their guidance for the year because of some of the challenging, potential tariff environment. In addition to the extending of the CUSMA, the old NAFTA agreement. So there's definitely, I think that will be the most important part, to see what visibility companies have for the balance of the year. Now that input costs have gone up quite a bit. Wage inflation is still sticky and high. Obviously, chemical and petrochemical prices are 20-25% higher, so input costs are higher. Now, somewhat offsetting that, we've seen, certainly some early signs of productivity enhancement due to, new AI tools and things like that. I don't want to get carried away, but there are some different forces sort of buffeting the overall growth and inflation picture that I think could mean that, earnings stay pretty resilient. But just whether companies will go out on a limb, they have really an excuse to suggest that, well, they were going to make earnings, but now it's a little bit unsettled. And with a high multiple, as we've seen, still, I don't think you want to put stick your neck out too far in extrapolating Q1 earnings out on the rest of the year because of some of those challenges that we had. But honestly, earnings are accelerating relative to the run rate of the last 2 years. A lot of that is technology. A lot of that is these advances that we've seen in chips and the spending that we've seen from the economy at $600 billion in terms of CapEx. It is really pushing the economy along, in addition to the one big beautiful bill and some of that tax relief that is helping the consumers. Now, there definitely is a K-shaped economy. I mean, the higher end of the economy is definitely holding up the lower end. But so far, as long as people keep their jobs, that income effect is alive and well. And I think the economy is was on a good path, at least going into this war in the Mideast. So I think all eyes are on how quickly this de-escalates. And you've seen that the stock market has come back all the way back to new highs. So it really was a repeat of what we saw last spring with the Liberation Day tariffs and that acronym of TACO, right? I don't have to tell you what that means. Trump always chickens out. I mean, I do think that, ultimately he is looking to go in solid to midterm elections, and he cannot have oil prices north of $100. So the most likely path is an off-ramp and, a claim of victory, whether it's the objectives that they set out to achieve or not. It will certainly be portrayed as, a victory for the U.S. And the more that we can focus on sort of domestic issues, or the U.S. focuses on domestic issues, on affordability and things like that, the more that I think we can get back to, growing those earnings. As you said, we're very strong. But we do worry that, it's not that, multiples are below median. Multiples are in the top, 85, 90 percentile historically. Now that goes along with exceptional earnings growth, really earnings growth that has been better than history. So you may say that, the market is closer to fair value, but it's definitely not cheap.
Right. So maybe if you think about valuations and earnings and where stocks have gone, and the last number of years have been very strong. Part of our collective role is to allocate assets across geographies, across sectors, across different strategies. You mentioned gold. I know we've talked about private assets before. Over the last year in the multi-asset strategies that you manage and that we manage on behalf of clients, we've seen some fairly significant shifts. An example is, from the U.S. market, which historically has done very well, to outside of the U.S. borders. And that wasn't done in anticipation of tariffs or of, a Middle East conflict, but was done purposely for investment management, multi-asset approach. So maybe just give us kind of a background as to where we've come from and why we're in the asset allocation that we are today.
Right. I think, it's really important. The U.S. has been a juggernaut in terms of the performance of that market over time. I think there's been a few different themes. Obviously, capital light over capital heavy. If you think about the Canadian economy and the Canadian stock market over the last, 7, 8, 9, 10 years, capital heavy was a bad thing as interest rates came off their bottom. And a lot of these companies are indebted, right? So that's a bit of a headwind for them. When you think of the U.S. economy and the U.S. stock market particularly, it's very capital light. So free cash flow businesses do really well. So in an environment where you start to see interest rates go up and the cost of money start to go up, I mean, the U.S. Was doing exceptionally from an earnings perspective and interest expense. I'm talking for the overall index. Clearly, underneath the hood, there's some small cap companies and small caps are struggling, and other companies that have large debt loads like cyclical industries, and financials and things like that. They exist in the U.S. They're just a much smaller proportion than in other markets like a Canada, like a Europe, where it's more of a cyclical market. So, that was a really good thing for a long time, and that really drove earnings. But, I think what we've seen in the last, let's say, since, Trump has been elected is he's really tried to make some changes on the U.S. That doesn't necessarily mean changes and better performance out of the stock market. He's really focused on the economy. So bringing back manufacturing jobs, that's noble, and you may do it. But at the end of the day, if you look at the last decade, the U.S. has won because of their outsourcing on the economy. Now, they may have lost jobs, but if that's a higher priority, you're now going to actually go against what has made the U.S. stock market such a juggernaut. So I think investors need to think about that and began to think about that by derating the U.S. market a little bit. So I'll be the first to say that our earnings growth expectations for the U.S. were very, very high, but we were suggesting that you'd see some derating because at 25 times, there's not a lot of upside, right? If you think about, the two things that drive stock performances, as you said, over the long term, it's fundamentals, but, over a medium term perspective, it absolutely is how much you pay for that stream of earnings. And if you're paying, 95th or 100th percentile, you have basically nowhere to go but down on valuation. So you better be sure that those earnings are going to over deliver because you now have a headwind from that multiple contraction. So for the last, 9 to 12 months, we've really been advocating being outside of the U.S. As you mentioned, the U.S. still represents, a third of our equity book, let's say, but relative to a lot of our competitors that are closer to half, I think that was, bold positioning that allowed us to really, perform pretty well on a relative basis. So other markets had opportunity for both earnings growth in addition to multiple expansion. You saw that in Japan, you saw that in Europe, you saw that in Canada most significantly. You also saw that in emerging markets. So really all the non-US markets have finally had their day in the sun over the last 9 to 12 months. And we would expect that to continue because, to be honest, you haven't really seen an exodus from heavily leveraged and long positions in U.S. assets. What you have seen is some hedging on the currency. So folks have said, well, I want exposure to the U.S. stock market, but with all the things that are going on, the weaponization of the dollar, trade frictions, pulling out of NATO, geopolitical, recession that I talked about before, that doesn't sound very good for the dollar. Not to mention, fanning the flames of inflation, right? Saying that, Powell must cut. I think as we're seeing, we came into the year with cuts priced, at least 2 to 3, but all of those have been priced out now. So it looks like, that sort of interference wasn't necessary. But that's part of the reason that folks are a little bit concerned about, the US dollar and its long-term role. You've seen gold as a result rally. You've even seen Bitcoin and digital currencies perform a little bit better. So all of that sort of thesis was that, the US has got some great companies, the most dynamic in the world, the most dynamic capital market, and a wonderful, leadership, I think, in AI. But, to the extent that a different economy globally appears, I think there was an opportunity to be a bit contrarian and have some of these other markets bounce from an earnings perspective, in addition to sort of that multiple expansion. So we've been overweight those areas, and that's worked well.
Right. Yeah. And ultimately, when we're building portfolios and we're talking to clients, it's about managing risk. It's about tying those investment returns to clients' financial goals and long-term roadmap, and having that approach to global diversification has worked in good times and in challenging times, in periods of volatility, because each individual component part may be working differently at a different time. And I think this is a perfect example of that, where the rest of the world seems to be working a little better, just from a pure return perspective than the US, but the US has certainly contributed to return significantly over the last 10 plus years as well.
And even if you look at that, Damon, just to take it a step further, within styles, right, and even sectors, and I think those are kind of, two sides of the same coin. But natural resources have roared back because you've had, energy come back as a result of oil prices, but also a resilient economy. And the fact we actually went overweight energy at the start of this year, again, not having any clairvoyance about a Middle East war, but it was the one cyclical sector that was not priced for resilient growth this year, and inflation continuing to be sort of 3%. So we really got fortunate in a way to have, kind of the cherry on top was, well, and now we're going to guarantee, well, there's no such thing as guarantee, but now we're taking the probability of being a lot higher that oil, maintains an $80 handle, let's say, for the balance of the year, which interestingly is really important for energy companies. I mean, they don't want the demand destruction that may go along with $120, $130 oil. I mean, I think that is sort of a recessionary kind of outcome. So to the extent that, but I think that risk premium in oil, suggests that it's not 60 anymore, and we're awash with oil, too much of it, because there's a difference between production and actual supply. So there's a lot of stranded sort of supply on tankers and things like that have been produced but are not available to meet demand. So at the end of the day, we're seeing that's flown through into value outperformance versus growth for the first time, and I can't even remember how long. So it's not just geographic diversification; it's owning commodities, it's owning resource stocks, it's overweighting Canada because of more exposure to those resource areas. And having style diversification, there's more than just the growth game in town. Growth continues to be a big part of the portfolios, and I still believe in it. But to your point, diversification has really sort of paid off recently across a whole different number of factors.
Yeah, that's a great point. Okay, last question. Let's kind of look ahead to the rest of the year and potentially into 2027. Maybe one thing that you're really excited about, and then one thing that may be keeping you up at night, whether it's the continuation of what's going on in the Middle East or something completely different.
Yeah, I worry a lot these times more than I mean, as an analyst, as a PM, we're paid to be worriers, and that's one thing that we can't emphasize enough. It's it's hard to manage return. I think what we focus on is managing risk and expecting, that return associated with that risk to pay off. So there's no shortage of things to worry about on the risk front. What I would say is that, the market is being, and I'm not calling for weakness necessarily, but when we look at the market on a top-down basis, we're struggling to get a lot of upside from here. You could have some, but to the extent that oil prices stay higher and begin to damage the economy, everyone thinks, oh, it'll be a short war and all of a sudden things will roll off. But we've now affected, natural gas, oil, future production, costs are going up, shipping insurance. The more that this war goes on, the more that ultimately that will undermine the positive tailwinds that we had coming into this year with the One Big Beautiful Bill, and with better growth and really, I would say, economies around the world having very aggressive, liquidity positions. So what I mean by that is, all else equal, central banks probably with this inflation target would have been, maybe taking up interest rates a little bit, as Australia has recently done, because inflation is still missing targets, but they really haven't. And at the same time, too, fiscal policy has been really, really loose. So I think there is a very strong tailwind. It's just if this war goes into June, let's say, I would be really worried about the back half of the year. Coming off that really resilient growth trend, while inflation is certainly going up from here. So that puts policymakers in a bit of a bind. By rights, we see stagflation, and stagflation is not a great environment, certainly for nominal bonds, but also for a number of areas in the stock market as well. So I guess my biggest worry is that the longer this war drags on, the more that's going to damage the second half of the year. And you may see that as early as this quarter, as I mentioned, with some of the outlooks that companies will give in what we expect to be an otherwise tremendous earnings season. So that's my biggest worry. I think and part of that is associated with the fact that we're at all-time highs now. Oil is up 25%. Other input costs are up a lot. To me, that says that margins probably need a bit of a trajectory. Now, the good reset lower. Now, the good news is we're at all-time highs. So we have been super efficient, and corporates have had great margins. But if we get a quick resolution to this war, I think the one thing that I'm pretty positive about is we've seen this rotation, right? So other markets have done some heavy lifting. The S&P has actually come down a little bit. And some parts of the market, like technology, which I think will be a long-term, great sector, and you're able to buy some of these, some of these stocks, especially with the software sell-off, at really reduced multiples, even like COVID multiples. So the rotation that we've seen in the market has actually enhanced some of the breadth in the overall market, which is really necessary, I would say, for an extension in this bull market. So that's kind of what I'm hopeful about. If that continues, I think energy companies, utilities, it's not just all about tech or consumer discretionary. I think that's actually a market positive from a breadth perspective. So I'd be hopeful that really does continue. Yeah, and lots of other things to worry about, I think. Well, maybe bring it back to Canada. I'll say the one last thing. This is the time for us to invest heavily and to increase that diversification that has hurt us by just relying on the U.S. to always be there. And I think from a Canadian economic perspective, now is the time. And I'll be disappointed if that doesn't move forward quickly, because I think we've been not lucky, but we have the right sector mix to have outperformed in this macro environment. But to continue to do well, I think we need to make those economic investments right here and now. Never let a good crisis go to waste.
And yeah, exactly. Do it quickly, right? And I think just your point on the breadth of the market, what we had seen, just for everyone listening, the last number of years, a smaller number of stocks driving the lion's share of the market return in the US in particular. And as Steve was saying, the positive out of this is that the market has continued to grow, and the underlying drivers of return are being diversified out across many multiple sectors. So that's a positive to see in the overall health in the market. Well, listen,
Perfect.
Steve, thanks very much for your time. Very insightful. I know it'll be appreciated by all of our clients, and we look forward to chatting with you again soon.
Sounds great. Thanks for the opportunity, Damon.
Absolutely. Take care.